Hello everyone, and welcome to today's session. On behalf of everyone at Rev.io, I'd like to thank you for joining us today. Before we begin the presentation, I'd like to go over a few housekeeping items. First, audio will automatically come in through your computer speakers. However, if you're having trouble using your speakers or unhappy with the quality of the sound, you can call in using your phone. Second, a recorded version of this webinar will be emailed to you for on-demand access within 2 weeks. And lastly, the presentation deck and a few other handouts are available for download in the control panel. For those of you just joining us, welcome. Our topic today is Preventing an Audit 101. It's going to be a great show. Without further ado, I'd like to introduce today's speaker, Jonathan Marashlian with the Commpliance Group. Jonathan counsels clients engaged in the communications, voice over IP, SIP, cloud communications, IoT, and broadband industries on virtually all aspects of federal and state communications, law, tax, and regulation. Now I'll turn it over to Jonathan.
Thanks, Olivia. Good afternoon, everybody, and good morning to everybody joining us on the West Coast. As Olivia just mentioned, my name is Jonathan Marashlian. I'm the managing partner of Marashlian & Donahue, the Commlaw Group. I'm also the founder and CEO of the Commpliance Group, which is our law firm's affiliated regulatory, corporate, tax, consulting, and compliance services firm. I'm very pleased to have this opportunity to talk to you about tax and regulatory compliance issues and sharing with everybody our firm's recommendations on how you can optimize your company's compliance. Now, let me first confess that the title of today's webinar is a little bit of a misnomer. Preventing an audit isn't really possible, since about 99.9% of the time an audit is completely random. Unless, of course, your company is raising all sorts of red flags, in which case the randomness goes away. But for the most part, audits are a fact of life for any business, and the situation's really challenging for companies that are operating in the cloud communications industry, where audits become more common because service providers can and often do transact business across state lines in many different states, localities all across the country. Since audits are mostly random, even the most conscientious and meticulous business really can't guarantee that its high degree of care will result in audit avoidance. But what you can do is be prepared, and being prepared to make sure that you minimize the impact of an audit, to minimize the burden on your internal resources, and ultimately to minimize the potential economic harm an audit might cause or impose upon your business. So instead of thinking about avoiding an audit, I want everybody to think today's webinar as an audit survival guide, where I'm going to be sharing our firm's recommended best practices, 10-step process, practices that your company can implement now to ensure that when an audit notice does arrive in the mail, you won't freak out. Instead, you'll be ready, and you'll be able to defend your tax and fee billing, collection, and remittance practices, and you'll go into the audit with a significant leg up on the auditor. That's the goal. I want everybody to walk away from today's webinar knowing that an investment of as little as $5,000 to no more than $10,000 today will position your company to save tens, even hundreds of thousands of dollars and untold man hours when the inevitable audit notice arrives in the mail. So let's start things off by talking about the compliance challenge that confronts multi-jurisdictional telecom and VoIP service providers. And Olivia, I don't have control of the slide deck, so if you wanted to just forward to the next slide. Great, thank you. So despite all the talk about deregulation, the telecom industry remains one of the most heavily regulated and taxed industry segments in the U.S. Even President Donald Trump is powerless to minimize the compliance burden, since the federal government only has control over what the FCC does. When it comes to tax compliance, the FCC is the least of your worries, since telecom services, including voice over IP, is taxed and subject to 911 fees in every state in the union and thousands of localities in between. The tax regime applicable to telecom services all stems from a century of laws and regulations at all levels of government that were enacted when the number of telecom providers could be counted on one hand, indeed one finger. The Bell monopoly. It was a tremendous source of revenue for taxing authorities all across the country. And just because new technologies came into existence since the once monopolistic telecom market turned into a thriving competitive market, didn't mean the government stopped relying on revenue from telecom services. The communication service industry is among the most heavily taxed and regulated industries in the U.S., with over 300 types of telecom taxes, fees, charges, surcharges, all ranging across 7,000 jurisdictions at the federal, state, and local levels. Nationwide, a company that is providing service in every zip code could find themselves having north of 40,000, almost 50,000 different regulatory or tax filings per year per legal entity. And due to the breadth and complexity of the compliance challenge, many communication service providers often use tax calculation services and sophisticated billing systems to help them determine the appropriate taxes and fees. Then they outsource the return prep, filing, and tax fee remittance to compliance professionals. But don't be fooled, because tax and fee compliance is anything but automatic. There's no one-size-fits-all approach, and no software technology is perfect. But as you'll learn through this webinar, there are several steps you can take to ensure that your company is getting the most out of your software by investing in experienced tax professionals who can help you structure your operations, your accounting practices, your marketing billing practices, and doing it all with an eye towards getting the best, most accurate results from your billing and tax software platforms. So let me back up one, two, there it is, that's the our perspective. So our perspective on what's needed to be audit prepared and nearly bulletproof going into an audit or an investigation is based on many years of our firm representing clients in state and local tax audits all across the country. It's drawn from our experience defending clients in over 24 USAC contributor audits in the past 5 years, and it's been confirmed based on our experience defending clients against SEC enforcement actions for more than a decade. Our perspective is that in order to be ready to defend your tax and regulatory fee billing, collection, remittance practices, you must start from the beginning, from the ground up. And almost universally, it begins with selecting your billing platform and its associated tax calculation software. Why is this so important? Because of the multi-jurisdictional issues I just explained in the prior slide. The breadth and diversity of taxes and fees at the federal, state, and local levels makes it nearly impossible to effectively manage compliance without using the best-of-breed software and best-of-breed content. But it's more than just picking the right software solution. It really does take more. You have to get the most out of your investment in software, because if you don't, you're going to end up with the garbage in, garbage out dilemma. A proper integration of your company's products and services into Rev.io and your chosen tax calculation engine, whether it's SureTax or Avalara, this can be a complex and time-consuming process because of all the factors, variables, the risk assessments, judgment calls, and I'll get into some of those in the presentation. All of these things come into play when making your decisions on how to tax and assess fees. On this slide, I'm not going to get into all of the micro print, but I've summarized some of these issues. So after the event, if you want to download the presentation and read them in more detail, please feel free to do so. So again, most of these we're going to get into in just a moment. And if you could forward it to the next slide. There we go. In our presentation today, I'm going to demonstrate how working with a professional services team and following our best practices approach to your company is going to be able to not just survive an audit, but make the entire process a little less painful and less draining on your resources. And I really want to be clear, these are best practices that you can implement not only as a new entrant, but even if you've been in the market for a while, because it's never too late to correct bad habits. This slide lays out some of the bad outcomes that happen to companies that fail to follow a best practices approach when implementing and managing their billing system and tax engine. Assess too much or the wrong taxes and fees, and you're going to end up finding your company exposed to customer liability. You're also going to be non-competitive in terms of your market position. because the bottom line price of your service is going to be more than your competitors if you're not using best practices to minimize your tax and fee obligations. So if you neglect to assess too many taxes, or you do the incorrect taxes and fees, now you're going to find yourself exposed to out-of-pocket liability to Fed, state, local governments. And if you go ahead and ignore the collateral impacts on existing operations, you're going to threaten to expose your legacy business to multi-jurisdictional sales and even income taxes. So again, it's very important to go through a best practices approach. So here they are, 10 best practices. You can also call them steps in a process. Again, whether it's multi-step, sequential, or picking the ones out of these that you really need to do based on where you see the need. This lists what we're going to be going through in the next several slides. The first best practice is to evaluate your corporate structure and to determine whether or not entering into the communication services market might expose your legacy business or some affiliated company to tax liability in multiple jurisdictions, whereas previously you may have avoided those taxes due to a lack of physical presence for sales of products. What happens nowadays is that the low entry barriers for companies that entering into the telecom business, while very inviting, can lead a lot of companies down a very dangerous path. This is particularly true in the case of established companies with established lines of business that are far afield from telecom services. One of the most common examples I run into in my practice is a PBX or telephone system vendor that decides to start selling cloud communications, SIP trunks, and the like. Some of these companies are channel partners or VARs or VARs of the big telcos, equipment manufacturers, or other systems integrators. What they all have in common is that they've been in the equipment side of the telecom industry. But due to customer demand, market pressures, they're venturing into the telecom services side. Too often these companies want to dip their toes in telecom, or they otherwise rush into the market without thinking through how entering the very distinct business of selling telecom services can have a serious impact on their legacy business, potentially exposing previously untaxed sales to taxes in jurisdictions across the country. A good example of this is the company that sells handsets out of Texas but ships all of its products to out-of-state customers via common carriers. Doesn't have any other contacts with any other states. Well, if that same company starts to sell telephony services to customers in California, New York, Illinois, that company is creating Nexus where previously didn't exist. Now, due to poor corporate and tax planning, a company that had avoided taxes and income tax exposure in all states but its home state of Texas could find itself exposed to multi-state taxation due to the Nexus for One, Nexus for All legal precept. Now, there are solutions and there are ways to mitigate against exposing a legacy business to unexpected consequences, but these mitigation efforts can't be implemented after the fact. These are the things that have to be put in place before entering the market, and avoiding creating that unintended nexus. So this is why I list it as the number one step in the process, because it really is the first thing you have to do if you are contemplating entering the market. The number two best practice we recommend is to spend a good deal of time and effort to develop a product catalog that forces management and responsible billing personnel to evaluate the tax and fee issues whenever a new product or service is being developed. As I'll explain in an upcoming slide, a good product catalog goes hand in hand with a strong and well-developed internal tax policy guide. The product catalog itself is really just a detailed list of all the products and services that will be sold to customers as separate line items on the customer invoice. The document's used to map each offering to a specific code assigned by the tax calculation engine, so SureTax or Avalara. That makes sure that the product or service is going to be assessed the appropriate taxes and regulatory fees. A meticulously maintained product catalog is required for accurate mapping of billable line items for tax calc software. The product catalog must contain all the fields necessary to capture both the data and the tax policy decisions. We provide you guys with the tools and guidance to help service providers through the whole process. And this is just a simple example of a product catalog that has the level of detail that we find is necessary. And I really want to draw your attention to the final column. That's your internal tax policy notes. This is where you can reflect from your tax policy any of the unique decisions that were made when you ended up choosing the mapping code, and also identifying any overrides or allocations that were plugged into SureTax or Avalara to ensure that the output is going to match your expectation. So moving on to our third best practice, it's educate yourself. This might sound like common sense, but you'd be surprised how many businesses are entering into the telecommunications marketplace that know next to nothing about the regulatory and tax environment, which is crazy when you consider that telecom is among the top 4 most heavily taxed and regulated industries in the U.S. It's right up there with some of the sin taxes, alcohol, gasoline, and tobacco. It's really important to educate yourself before you enter the market. Why? Because not knowing what you're selling and how what you're selling is treated for regulatory purposes can really cost you a lot of money and pain down the road. I'll use one very common example just to highlight the importance of educating yourself about the different consequences that can arise depending on what you sell and how you sell it. The contrasts between being designated as a CLEC or a competitive local exchange carrier as opposed to being qualified and having a classification of an interconnected voice over IP provider are pretty significant. So if you're selling services that are considered to be CLEC services, your company is going to need to obtain full-blown licenses, CPCNs, from almost all 50 state utility commissions. That process alone of obtaining CLEC licensing can cost anywhere from $100,000 to $250,000 in fees, expenses, and it can take up to a year before certain states grant the licenses to operate. Now, you contrast this with being an interconnected VoIP provider, where only 22 states have asserted any regulatory authority over such services, and at this moment, solely for the purposes of getting contributions paid to certain support programs, like state USF funds. Because federal preemption preempts states from regulating market entry and rates of VoIP providers, there are no licensing requirements, only registrations which can be procured in a matter of days or weeks at most. Another area where doing some self-education is critical is the growing area often referred to as the Internet of Things, or IoT. IoT is so new, so diverse and wide-ranging in what it encompasses, and so untested before regulators and tax bodies, that two companies selling the very same solution could find out that one company is regulated and taxed as a telecom provider, whereas the other is treated as an unregulated, untaxed information services provider, simply based on how each company markets, bundles, and bills for the finished service. I won't get into the details here, but I've provided a few documents you can download that highlight the importance of sorting out these issues before you go to market. Number 4, best practice. Number 4 step in the process, analyzing Nexus, determining which jurisdictions have legal authority to impose taxes on the services you provide to end users. So every state and local government has the authority to tax, but that authority is limited by constitutional principles of due process. So what is typically required in order for one state to impose tax collection duties on an out-of-state company is what's referred to as Nexus. Nexus is the amount of contact you have with a state. Now, Nexus is very often misunderstood and its importance is overblown, especially in the context of telecom services. So whereas in the context of the sales of physical goods and products, there needs to be some sufficient physical contacts with the state, when it comes to telecom services, on the other hand, the physicality threshold is much, much lower. In fact, the general rule of thumb is that if you provide a telecommunications service to a customer address located in the state, and your company derives an economic benefit from the customer, and your company is using any physical infrastructure within the state to connect to the customer, even an unaffiliated third party's infrastructure like an independent ISP's broadband connection, then this contact is going to be sufficient for most all states to establish Nexus over an out-of-state company. The fact of the matter is that physical Nexus is giving way to the concept of economic Nexus. And this is getting to the point where states are actively seeking to force the Supreme Court to reconsider the Goldberg ruling that gave birth to the whole physical presence test. Nevertheless, we still recommend getting educated about Nexus because far too many businesses continue to operate under the mistaken belief that if they aren't physically located in a state, and don't otherwise have a physical connection to the state, then it means they don't have to comply with state taxes. So to learn the basics on Nexus and document management's decisions on whether your company is going to be conservative or take an aggressive and in our opinion, a risky position that relies on the crumbling Goldberg physical presence test, you really need to do that. Because lack of physical presence is always going to be the first argument we make to an auditor. But in our experience over the last 5 years in state and local jurisdictions from coast to coast, tells us that it's a loser. It's a bad argument. Almost universally, that argument has lost. So unless you have the resources, the time, money to take a Department of Revenue, to take a state taxing authority all the way to the Supreme Court, and presuming the Supreme Court wants to hear your case, be my guest and take a more aggressive position on physical presence. But it would be our recommendation that you do what the industry norm is these days, which is assume Nexus exists. Now here's another very important area that is often overlooked. Tax citing, also referred to as revenue sourcing. The fifth best practice is really more than a best practice. It's a required step that must be taken to ensure that your company is imposing the correct state's taxes on your customers based on the unique revenue sourcing rules of the impacted jurisdictions. Your customer service address, billing address, place of use can be treated as the tax situs. But choosing which one of these options is applicable to each of your customers is not a universal decision. It can differ for every company, oftentimes depending on the facts your company has reasonably available to it. The best option from the taxing jurisdiction standpoint is always going to be the service address. Where you're providing the service, where is the customer consuming the service, how much revenue is being derived from that service address. For example, however, let's say you have a customer headquartered in New York City with its billing address in New York City. However, your New York City customer assigns half of the seats on a cloud PBX to workers in Jersey City, their satellite office right across the Hudson. Is it correct to source 100% of the revenue to New York City and apply New York City taxes to every dollar billed? Well, if you know or reasonably should know that your customer is using 50% of the seats in New Jersey, then the answer is no. New Jersey will have the right to seek taxes on 50% of the revenue. How can a carrier be expected to know where its customer is deploying seats on a cloud PBX? Pretty simply, actually. Since VoIP providers are required to provide their customers with 911 access, and the ability to update their registered 911 address in real time, tax auditors have come to know that they can solicit information from your company or your third-party 911 vendor, bandwidth or whoever you're using, and based on the registered 911 address in the system, they can verify that your company had knowledge or should have had knowledge of where its services were being consumed. So don't let tax citing issues sneak up on you in an audit. If you haven't taken steps to mitigate potential exposure, there's no time like the present to fix it. Now, this is probably one of the single most important best practices I could recommend to a client, because when you engage in a tax and regulatory fee optimization analysis and you arrive at results and decisions that are then documented in an internal tax assessment and remittance policy, this guarantees that you've been exposed to all of the most important issues, all the factors, considerations, all the things you need to be aware of when it comes time to make the best decisions on how your services are going to be taxed and subjected to fees. If you undertake an optimization analysis and end up with a well-formulated internal tax policy, I know that you've been given the opportunity to look at, to think through all of the gray area issues. I know that my client has given thought to the tough calls. It's made a number of risk-based decisions, all of which are going to be documented for future reference. I know that my client has reached certain conclusions that balance the risks and consequences of over-collecting taxes and fees against the risks and consequences of under-collecting. And at the end of it all, I know my client has a policy in place that can help them make similar determinations each time my client adds or changes a product or service. And they don't need to call me, and they don't need to call a consultant every time they add a new product to their catalog, because they have a step-by-step guide that walks them through the process, and they can reflect on the decisions that they made with regard to similar services and they don't have to contact us, and they can save money going forward. The decisions that are made and documented in your internal tax policy, these are really at the heart of your billing system. Because as they say, and as I've been saying, if you put garbage into the software, it's going to be garbage coming out. And while there are going to always be some imperfect decisions that you have to make and then flow through your billing software and tax engine, at least you'll know where the bodies are buried. You'll know which issues to monitor the legal, regulatory, tax developments, because as the rules evolve, it might change the risk assessment that underpinned your original decision. You'll know how to go back and which decisions to correct, to update. Your billing system and tax and fee compliance, it's a living organism. It's going to evolve. And there really is no better way to achieve certainty with regard to your tax and fee decisions, than to have it all documented in a tax policy. Again, even when that certainty is based on simply knowing all the pros and cons, the risks and consequences for all of your decisions. Implementing optimization strategies early in the onboarding process can result in a significant reduction in your tax and regulatory fee liability. And it really does improve your competitive positioning in the marketplace by ensuring you're only billing those taxes that you have to be. All right, so we're at the best practice number 7. This is actually more of a step number 7 in the orderly process that I'm recommending. Tax mapping. Some of you, I'm sure, are already well aware of tax mapping. It's probably the one issue when it comes to tax compliance that you are aware of. Some of you may have skipped straight to doing the tax mapping. And maybe some of you are thinking of skipping straight to tax mapping. I don't recommend doing so. Why? Well, if you don't really know what you're selling and you don't know what gray area issues you have to make decisions on, you don't know how it might impact an affiliate, you don't know how to cite as revenue from what you're selling, you haven't optimized your services, and yet you dive right into mapping, it's just a recipe for disaster. Trust me. So you're going to have some problems lurking right beneath the surface if you dive right into tax mapping and don't pay attention to some of the precursor issues. So sometimes companies are in a rush to get to the market. You actually do things that only become apparent years into the future, and by the time the warts are revealed in an audit or an enforcement action, it's probably too late. You've either over-collected or under-collected for months, possibly years, so you've got accumulated over-collections or accumulated under-collections. You're either going to be paying out of pocket or you're going to owe refunds to your customers. So it really does pay to take a methodical approach, the one that we've been discussing in this 10-step process. I don't think it's really necessary to get into the nitty-gritty details of the tax mapping process. The key point that I wanted to make is that tax mapping is where the rubber hits the road. It's where all the tough judgment calls on the gray area issues have to be implemented into the tax calculation software. You have to sometimes manipulate the software to get the best results. Overrides, testing different allocations, unbundling the bundles. So a variety of different things that you do during the course of tax mapping that turns the process more into an art than it is a science. It's one area where I really advise against trusting amateurs or even just your instincts if you want to get the best long-term results. So step 8, best practice 8, technical integration. I'm not going to spend really any time at all on this slide, and the reason why is because if you're using Rev.io, this isn't a step in the process that you have to worry about. The reason for that is Rev.io and the 2 tax calculation vendors it works with, I think SureTax and Avalara, they've already worked tirelessly to iron out all of the kinks and the APIs, and so right now their software platforms talk very, very nicely to one another. They play well together. So we won't spend much time here. Some companies that are working with a billing platform that hasn't been integrated with a tax calculation engine, is going to find this to be one of the challenging steps in the process because APIs have to be built, tested, and so forth. Speaking of testing, number 9. So you've gotten all the way through the implementation of your billing system and tax engine. And now what you do before you pull the trigger and go live with your invoicing of customers with all the taxes and fees, test, test, and test. Don't go live until you've sufficiently tested everything. Don't go into production mode until you've fully satisfied yourself that the state taxes and fees are being applied to your services exactly as you would expect them to be based on your tax policies and the mapping decisions that you made. Nothing's worse than putting in all that effort to get the right results only to find out months or years after going live that something was missed that could have been corrected if only you'd done some testing of your invoices. If you spot errors, changes can be made to the mapping determinations. You can implement tax calc software overrides as needed, and you can update your internal tax policy to reflect any unique issues that only rear their ugly head during the invoice testing process. Now, last but not least, number 10, trust the right folks to help you manage your company's compliance with FCC, state and local tax, 911, regulatory compliance at the utility commissions. What's compliance reporting? Well, once you bill and collect taxes and regulatory fees, that money isn't yours to keep. In fact, if you keep it, you could go to jail for tax fraud. Rather, your company is the tax collector on behalf of governmental agencies all across the U.S., and each one of those thousands of jurisdictions that impose taxes and fees, fee collection duties on you, will require you to get that money into their pockets, oftentimes through a wide diversity of methods. There's no single place you can pay all the taxes and fees. Every single jurisdiction must be paid directly, and this can create an incredible administrative burden. So trust folks like the Compliance Group to take care of these burdens for you, and try doing it yourself, and you'll quickly learn what it's like to drown under a pile of paperwork. And before concluding, I just wanted to present a slide that lays out some of the things that our firm, our organization can do. Now that you've seen how you can go through a very thoughtful, meticulous, and well-organized tax implementation process, you can proceed, and you've seen all the areas we recommend covering. Now you have to ask yourself the question, why haven't we done this already? I'll try to give my first answer, and that's probably because you think it costs too much. What would it cost for the average-sized company to do it the right way, and how long would it take? Generally speaking, our firm charges between $5,000 and $10,000 for a full 9-step process, and then you follow that up with the compliance services, and that's all based on where your company is providing services. Sometimes there are some companies that present more challenges. They have massively complex product catalogs, or they've been in business for a number of years and have more issues to correct retroactively. But for the most part, the cost of a compliance implementation project isn't out of reach. And really, the cost savings that your company can achieve over the long term really make the cost of doing it right the first time pale in comparison. And as I mentioned previously, one of the greatest things that you can get at the end of one of these projects is the do-it-yourself information. You're going to be armed not only with the education, but with the documentation and a pathway to make sure you can do this internally, that you can train internal staff to help do this in the future. So with that, I know we're a little bit early here, but I'm going to conclude the presentation portion of the webinar, and really does leave us a lot of time to open the floor to questions from our audience. So Olivia, I'm going to turn it back over to you.
Great.
And see if we've got any questions.
Thank you, Jonathan. That was very informative. I'd like to take a few minutes and answer a few questions from the audience. The first question is, how much does it cost to develop an internal tax policy? Well,
I think, as I just mentioned, The cost varies depending on the complexity that we're confronted with. But for the most part, if you're talking about a brand new company entering the market, it's going to be $5,000 or below. If you're talking about a company that has a modest sized product catalog, and by that we're talking about 25 to 50, maybe up to 100 distinct products that can be put on a customer invoice, and they all fall within sort of defined ranges of services like voice over IP, internet access, software as a service, things of that nature. We're not talking about any more than $10,000. And our firm does offer a whole bunch of different fixed fee options with structured payment options. So again, the cost burden up front shouldn't be a barrier to doing this and doing it the right way. Again, the one thing about getting it wrong on taxes and fees is that you are taking these steps before you enter the market, before you bill your first customer. They're going to be in place for the next day, the next week, the next month, the next year, 5 years, 10 years, and you don't know when you're going to get that audit notice. You don't know when a state or the FCC USAC is going to force you to take a close look at your tax policies and the decisions that you made with respect to different products and services. And when you talk about the compounding effect of doing it wrong for years, and again, the inability to collect taxes after the fact from your customers, there's a significant material exposure that companies have years into the future. So that's why doing an investment up front, or even if you've been in business but you want to stop the bleeding, so to speak, we highly recommend going through one of these well thought out processes so that you can get everything documented, you can lift up the hood and see what's wrong with the engine, make the tweaks that are necessary, and get it working well.
Excellent. That was a great question. The next one from the audience is, I understand that USAC has been very active with USF contributor audits throughout the Obama administration. Do you have any reason to believe USAC will be more or less active under the Trump administration?
Oh, that's a good question. Yeah, well, first I'll confirm that the past 8 years, in fact, it goes back even further than that, probably the last 4 years of Bush 43, USAC has been the 800-pound gorilla, the elephant in the room. They've audited, I know that they've gone from outsourcing audits to external auditing firms like Grant Thornton and Ernst & Young and PwC, firms like that did the audits in early years. Then they started doing them internally, and they've been very active. They've stretched the boundaries of their legal authority in interpreting FCC rules very, very broadly and in ways that capture more revenue, very surprising ways. And those audit decisions have to be appealed to the FCC. You're never going to win at USAC, I'll tell you that much, not on any tricky issue. So, anytime they're looking at a rule that has any way to interpret it in favor of more contributions to the fund, that's what they're going to do, and you're going to be very hard-pressed to succeed at the audit level of getting it overturned, which ends up putting you before the FCC's Wireline Competition Bureau, and once you appeal there, those appeals can sit for years. I mean, there's been an AT&T appeal that was filed in 2005 that still hasn't been decided. So, and it's an extremely costly process. So back to the question at hand, is this going to continue under the Trump administration, the Ajit Pai FCC? I've given some thought to it, and the one thing that's not changing. I know that President Trump wants to push through a reduction of regulations across the board by 70–80%, and the FCC is not going to be unscathed in that effort. But these are regulations that are on the books, and this is a matter of enforcing those regulations on the books. The Universal Service Fund isn't going anywhere. It's in statute, so in order to get rid of the Universal Service Fund, you'd have to have an act of Congress. And the fund is perpetually losing more money. It's perpetually giving out more money than it takes in, and that increases over time as more and more consumers shift from traditional telephony services and even shifting away from voice over IP to these Wi-Fi services and internet-based services that aren't defined yet by the FCC. So I would have to say that because of the pressure on the fund and the FCC's degree of independence, and it's an independent government administrative agency, my instincts would tell me that the auditing, the enforcement is really not going to be materially less than what we've been experiencing. Now, we've yet to have our first experience working with USAC in an audit under the Trump era, so I'll have to reserve final judgment on that one until we are confronted with that situation. But again, my expectation is that things are not going to trail off in a material way, that USAC will continue with its enforcement responsibilities, and it's one of those areas where I think even Ajit Pai has said that there are certain regulations that are pretty clear on their face, and we're going to enforce the ones that are clear on their face. And his enforcement philosophy really is that he's not going to extend FCC jurisdiction beyond where it clearly lies, given the statutory language. So he's a bit of a strict constructionist. But USAC operates somewhat independently. And USAC has a singular focus, and that is to make sure that there's enough money coming into that fund so that it can meet its obligations to pay out of the fund. And I just read yesterday or the day before that the contribution factor went back above 17%. It's now sitting at 17.4% for the second quarter. So really no pressure being relieved from the fund. Olivia, anything else? Any more questions?
Nope. Thank you so much. That concludes our webinar for today, and we look forward to following up with you all with the recording. And thank you, Jonathan, for an excellent show.
Thank you very much.